In looking at your most recent asset class forecasts, the one that sort of sticks out, especially because it has really underperformed during this recent rally, is U.S. high quality. That being sort of at the top of your list right now. Yeah. You've been fans of that for a while, and I've really always wanted to ask you, how do you define high quality? What? If you could unpack that a little bit, I think it'd be very
unbelievably ordinary. Like most of what we do, it's high return, stable return, and low debt. It has the way we do it, fractional difference between a Moody's rating and or an S&P rating. But very similar. Everybody, quality is quality. We kind of know what it is. It's a great franchise company. Mm-hmm. If you have high stable returns, you're fixing the price. You're a price setter.
Of course.
And you can only do that if you're a great franchise company. And of course, if you can do that, you don't need any debt, and so they don't have it. So it tends to go as a package. So our high quality companies are, whether we own them or not, whether they're cheap or not, are always Coca-Cola, Microsoft, Merck, and Lilly, and so on.
Yeah, it's interesting to hear because we do a lot of work at Morningstar on sort of competitive advantage, and again, I've just always been curious sort of how you define it, and as you put it, simplest is often the best.
Yeah, it's almost always the best, and when we try and get too clever, we always mess up. But they worked brilliantly last year. They were the only game in town, and we should have perhaps expected that this rally would hurt them. And we did half expect it. And I kind of warned about it internally. But what stopped us from doing enough was the fact that they were still cheaper than the competition. Mm-hmm. And for us, that value discipline is the bedrock, the 7-year forecast.
Of course.
It went into April with the cheapest numbers, the highest imputed 7-year return. And then, of course, it was flat for April, more or less, and the bad guys were roaring upwards as everyone tried to catch up, play the volatile stocks. And now, of course, the gap is immense again. And most of our fears about the future bear heavily on the junky companies. I think the 7 lean year hypothesis of all the things that will take some considerable time to work out of bear very heavily on the junk. They don't touch materially the high quality companies.